Most people are taught that the Great Depression exploded into existence on a single day in New York, when stock prices collapsed and panic spilled out of Wall Street. That story is neat, dramatic, and wrong. What followed 1929 was not an immediate economic apocalypse, but a slow, grinding downturn that the world believed it could manage. Factories still ran. Banks still opened their doors. Trade slowed, but it did not stop. The catastrophe that truly broke the global system did not begin with screaming traders or collapsing share prices. It began quietly, years later, in a European capital that once ruled half a continent. By the early 1930s, Vienna was a city living off memories. Grand palaces, wide boulevards, and cultural institutions still projected the image of imperial power, but the empire that had built them was gone. The Austro-Hungarian Empire had vanished after the First World War, carved apart by treaties that transformed a sprawling superpower into a small, landlocked republic. Vienna remained enormous, sophisticated, and expensive, while the country around it was poor, fragmented, and economically fragile. The city had been designed to govern millions, spread across Central Europe. Now it struggled to justify its existence within a nation that could barely sustain itself. At the center of this imbalance stood Credit-Anstalt, an institution that was less a bank than a financial nervous system. Founded in the 19th century and long associated with the Rothschild family, it had financed railways, factories, mines, and trade across the empire. Even after the empire's collapse, Credit-Anstalt remained dominant. By the start of the 1930s, it was tied directly to much of Austrian industry, sitting on corporate boards, rolling over loans, and quietly absorbing losses to keep the economy functioning. The survival of entire sectors depended on its balance sheet. This dominance created an illusion of strength. Credit-Anstalt looked indestructible because it was everywhere, but in reality, it was carrying the weight of a country that no longer worked as an integrated whole. New borders had cut supply chains. Tariffs strangled trade. Industries that once sold freely across imperial territory were now confined behind customs walls. Factories survived not because they were profitable, but because the bank kept them alive. Credit-Anstalt was no longer allocating capital. It was delaying collapse. For a time, this fragile arrangement held. What turned weakness into disaster was politics layered on top of finance. Europe in the early 1930s was haunted by the First World War and obsessed with preventing the return of German power. France, in particular, viewed any hint of economic cooperation between Germany and Austria as a threat. When Vienna and Berlin proposed a customs union to reduce tariffs and revive trade, it was interpreted not as economic pragmatism, but as a political provocation. France possessed a powerful weapon that did not require armies or ultimatums. It controlled large amounts of Europe's gold and short-term credit. When the customs union plan appeared, French financial institutions began pulling funds out of Austria. This was not announced publicly. It unfolded quietly, loan by loan, as foreign capital drained from the Austrian system. What was intended as pressure quickly became something far more dangerous. Inside Credit-Anstalt, the numbers were already grim. The bank had absorbed another failing institution at the government's request, inheriting bad loans that never should have survived. Losses mounted as industrial firms missed payments and asset values collapsed. By the time auditors closed the books for 1930, the truth was unavoidable. The losses were so large that they threatened the bank's entire capital base. On paper, one of Europe's most powerful banks was effectively insolvent. The leadership understood the danger of secrecy and the danger of disclosure. If the situation leaked uncontrolled, panic would erupt. If it was announced without support, the bank would collapse instantly. The decision was made to go public while staging a rescue. In May 1931, the Austrian government, the central bank, and private stakeholders pledged to stabilize Credit-Anstalt and absorb its losses. Instead of reassurance, the announcement detonated fear. Depositors heard only that the bank had lost vast sums. Foreign creditors ignored promises and focused on survival. Money poured out. Lines formed. International lenders demanded repayment. What began as a banking problem transformed into a currency crisis as Austria struggled to meet foreign obligations. Gold and foreign reserves evaporated in days. The government pleaded for international assistance, hoping for emergency loans that could stabilize the shilling and halt the run. Britain showed willingness. France imposed conditions. Assistance would come only if Austria abandoned its economic cooperation with Germany. Faced with the choice between political humiliation and financial collapse, Austria hesitated. Markets did not wait. Capital controls followed. Borders closed to money. Transactions froze. What had once been a crossroads of European finance became a sealed container. The message to global investors was unmistakable. Funds placed in Central Europe could be trapped overnight. Confidence did not merely decline, it vanished. Fear does not respect borders. Banks that had exposure to Austria began scrambling for liquidity. Their next concern was Germany, whose financial system shared many of the same vulnerabilities. German banks relied heavily on short-term foreign funding while supporting struggling domestic industries. When international lenders saw Austria freeze accounts, they rushed to pull funds from Germany before the same thing happened again. The pressure concentrated on major institutions until one finally cracked. In July 1931, a leading German bank shut its doors. Panic spread immediately. The government responded by suspending the entire banking system, declaring a temporary halt to transactions in an attempt to stop the hemorrhage. For days, one of Europe's largest economies functioned without banks. The collapse now threatened the entire post-war financial structure. The United States watched with alarm, recognizing that German failure would ricochet back through American banks that had financed Europe's recovery. President Herbert Hoover proposed a temporary halt to war debts and reparations, hoping to buy time and restore trust. Markets briefly rallied. The idea made sense, but delay proved fatal. Political disputes slowed implementation, and confidence drained away while governments argued. By the time agreements were reached, banks had already failed and capital had fled. What was designed as a stabilizing pause arrived too late. With Austria and Germany effectively shut down, the crisis shifted again, this time toward the core of the global financial system. British banks had lent heavily to Central Europe. When those funds were frozen, losses became unavoidable. Investors realized that British liabilities remained liquid while British assets were trapped abroad. That imbalance sparked a run on the pound. This was not a panic of ordinary citizens. It was a run by central banks and institutional investors demanding gold. Britain fought to defend its currency, borrowing abroad and imposing austerity at home. Spending cuts triggered unrest, including a mutiny within the Navy that signaled weakness to global markets. Confidence collapsed. In September 1931, Britain abandoned the gold standard. The pound fell sharply, and with it, the foundation of the international monetary system. Other countries followed. The world fractured into competing currency blocks. Trade barriers rose, and global commerce shrank dramatically. What had been a recession hardened into a depression. The United States, now the primary defender of gold, faced a brutal choice. To prevent gold from leaving the country, interest rates were raised even as unemployment soared. The result was catastrophic. Bank failures multiplied, credit dried up, and economic contraction deepened. The shock that began in Vienna reached farms, factories, and households across America. The economic collapse reshaped politics as thoroughly as it destroyed balance sheets. In Germany and Austria, the middle class was crushed between debt, unemployment, and lost savings. Democratic institutions appeared powerless. Extremists promised certainty, blame, and revival. Within a few years, radical movements moved from the margins to the center of power. The failure of Credit Anstalt changed how the world understood finance. It exposed the danger of treating banks as isolated entities, rather than components of a connected system. One institution's collapse had triggered failures across continents. The lesson was brutal and unforgettable. In an interconnected economy, liquidation does not cleanse, it infects. Out of this realization emerged modern financial safeguards, deposit insurance, central bank intervention, and the idea that certain institutions could not be allowed to fail took hold. Capitalism survived by accepting limits on itself. Risk was no longer purely private. Stability became a public concern. Yet the story does not end in the 1930s. The logic of contagion still governs modern finance. Technology has accelerated it. What once took weeks now takes hours. The same fear that emptied Viennese banks now spreads through digital networks at the speed of messages and markets. The collapse of Credit Anstalt remains a warning written into history. It shows how quietly systems fail, how confidence evaporates before laws can respond, and how financial decisions made in offices far from public view can redirect the fate of nations. The line between stability and chaos is thinner than it appears, and it is drawn not on battlefields, but in ledgers. Hey everyone! If you enjoyed this video and want to stay updated with more insights on finance, make sure to subscribe to my channel, Financial Coin, and don't forget to hit that bell icon so you never miss our latest videos.